Season's greetings from Edinburgh. A warm welcome to you all. My name is Martin Haggart and I'm the Technical Manager for Pensions at Aegon, and I'm joined again today by our Tax and Trust Manager, Elaine Cruickshank. Many thanks for being with us. We appreciate your continued interest and your ongoing support. Christmas is just around the corner, but before we down tools and enjoy some festive cheer, we're going to spend a bit of time today reviewing the wide range of current tax planning and advice opportunities. At the time of recording, the general election has recently taken place, and we're now awaiting a second Queen's speech and a revised date for what was going to be the November budget that was delayed by the election process. Nevertheless, it's never too early to start planning for the tax year end to take advantage of the many tax opportunities that currently exist. And our session isn't just limited to pre-tax year planning, we'll also cover some of the tax planning opportunities into the new tax year for good measure. Our webinar will run for around 40 minutes as your feedback shows that this duration best suits your busy schedules. We can, of course, provide more details separately on any of the areas covered today, and we welcome contact from you with any questions that you have. Our email details will be shown in the last slide, and you can also speak to your usual Aegon contacts, so please do get in touch. In the time I have available today, I'm going to focus on the tax planning opportunities with new pension contributions and with existing pension savings, before Elaine takes the reins to cover off many other tax planning opportunities. So let's get started. On the pension side, there's been little by way of legislative change from the government over the last year or so, and as I said earlier, we're still awaiting for confirmation of the revised date for the November budget. However, there is no shortage of talking points and advice opportunities available for pensions. Typically, at this time of the year, we concentrate on using pension contributions for effective tax planning purposes. Personal contributions to a registered pension scheme reduce a client's adjusted net income and therefore reduce the amount of income tax that they pay. And this presents a range of opportunities across the various income bands. We currently have multiple and diverging income tax systems operating within the UK. The income tax position for the rest of the UK for 2019-20 is shown here, with different rates and bands applying in Scotland. Wales also has had the power to set its own tax rates and thresholds since the 6th of April 2019, although these are currently aligned with the rates in the rest of the UK. Across the UK as a whole and across all income bands, there are many good tax planning reasons for making pension contributions. For example, non-earners and non-taxpayers can make personal contributions of at least up to £60,600 gross, benefiting from basic rate tax relief if paid to a scheme operating relief at source, for example, a personal pension. Higher rate taxpayers can pay a personal contribution to reduce and possibly eliminate their higher rate tax liability. Those with income over £50,000 with children qualifying for child benefit can pay personal contributions in order to retain entitlement to part or all of their tax-free child benefit. Those with income up to £125,000 can pay personal contributions to retain part or all of their tax-free personal allowance, attracting tax relief at marginal 60% between £100,000 and £125,000. And additional rate taxpayers can get almost half of their personal contributions paid by the government with tax relief at 45% or 46% in Scotland. These same angles arise every tax year. They're all excellent tax planning opportunities, and whilst pension tax relief remains at its current levels, these opportunities must be seriously considered. The rates and thresholds shown here are those applying in Scotland in 2019-2020. Many people living north of the border are paying substantially more income tax in 2019-20 than someone on equal earnings in the rest of the UK, mainly due to the higher rate threshold remaining at £43,430 in Scotland, £6,500 lower than in the rest of the UK. Also, those in Scotland also pay income tax at higher rates, for example at 41% on earnings above £43,430, as opposed to 40% on earnings above £50,000 elsewhere in the UK. This means someone in Scotland earning, say, $49,999 will be entitled to up to 41% tax relief on part or all of their pension contributions, whereas someone earning the same in the rest of the UK would only be entitled to 20% relief. For this individual in Scotland, a pension contribution of $6,570 would avoid them paying higher rate tax entirely. And it may be even more beneficial from a tax perspective if this contribution is made by way of salary sacrifice, with the employer adding in part or all of its national insurance saving. But effective tax planning using pension contributions needs regular and detailed financial advice. Otherwise, it's easy for clients to fall into traps. You'll see from the graph here, there's been a huge spike in annual allowance charges in recent years. The latest figures show that $173 million in annual allowance charges were paid via the scheme pays route in 2017-18, where the scheme pays the charge and reduces the benefits accordingly. But it was the excess contributions reported and paid by individuals in their self-assessment returns at the end of January 2019 that provided the biggest shock, with the value of contributions paid over the annual allowance reported at a huge £812 million. The process of determining the annual allowance charge requires the excess amount paid and by an individual and for an individual to be added to their other income and tax applied at the marginal rates. So these overpayments will have led to some very large and unexpected tax bills for many people. But why has this happened? The contribution rates were simplified a couple of years ago, weren't they? Well, it's true the standardisation of pension input periods in 2015 to run in line with tax years helped simplify things enormously, and a $40,000 annual allowance measured in tax years is easy to understand, for defined contribution clients at least. And the continued availability of carry forward allows any unused allowances available from the previous 3 years to be brought forward to the current year once the annual allowance has been exhausted. Any unused allowance that currently exists for tax year 2016-17 should be used now, otherwise it will be lost. Some clients are subject to the tapered annual allowance that could reduce their annual allowance down from $40,000 to perhaps as low as $10,000. However, even with such a reduction, it's still possible for this group of individuals to bring forward any unused allowance that they have from the previous 3 years to the current year. Bear in mind also that when working out carry-forward allowances, it's necessary to determine if the tapered annual allowance applied in any of the 3 previous years in order to determine the correct levels of unused allowance available for each particular year. Those who have flexibly accessed their pension benefits are subject to the lower £4,000 money purchase annual allowance with no ability to carry forward, not for any money purchase contributions anyway. According to government figures, there are nearly 1 million people over age 55 subject to the money purchase annual allowance. That said, there are still tax planning opportunities for this group of people too, in terms of the timing of taking benefits, taking small pots, lump sums, and remaining in cap down where possible to delay the restriction applying. So as you can see, the rules are not as straightforward as we'd all like, but there are opportunities for you to demonstrate your expertise and show clients how they can maximise their pension savings without causing undue tax complications. You will, of course, be familiar with the tapered annual allowance provisions that restrict tax relievable contributions for those with very high levels of income. The introduction of adjusted income and threshold income have not been the most straightforward to get to grips with. The fact that employer contributions are included in the adjusted income calculation but not the threshold income, and that personal contributions are deducted in the threshold income calculation but not in the adjusted income, has caused lots of confusion. Many clients have been and will continue to be unclear if they are affected by the tapered annual allowance, where their income fluctuates, large bonuses are paid, etc. And whilst these rules persist, it's an area that will continue to need careful tax planning. It may be that some clients who are unsure if they're likely to be affected may decide in the immediate term to restrict their contributions, including those from their employer, to £10,000, which is the minimum level that can be paid, and to hold any other possible pension savings in other investment vehicles until such times as things become clearer and the possibility of further pension contributions can be determined. We'd like to see the tapered annual allowance provision has been swept away completely, given the complexity it brings for clients. The Government has already committed itself to reviewing how the tapered annual allowance applies to members in schemes such as the NHS pension scheme. Also, the Office of Tax Simplification, which is an advisory body within the Treasury, has recommended in its October 2019 report on simplifying taxation for individuals that a review of the annual and lifetime allowances are carried out in order to ensure that they continue to meet their policy objectives and also to determine if both are required. So maybe there are some positive developments in this respect over the next few months. In the meantime, the good news is that as we approach the end of the tax year, many clients will be clearer of what their taxable income will be for 2019-20 and whether they'll be affected. That then presents a couple of opportunities. So if it turns out the client isn't affected by the taper, then there's an opportunity to maximise their contributions up to the annual allowance and also to look at using carry forward. For those who could be affected, is there any opportunity to pay a pension contribution, personal contribution, now such that it would reduce their threshold income to £110,000 or less in order to avoid the taper? Looking into the new tax year, as things stand, it will continue to be necessary to do numerous sets of these taper calculations, working out what the adjusted and threshold incomes for 2020-21 are likely to be able to determine the annual allowance for the new tax year, plus 3 sets of calculations for 2017-18, 18-19 and 19-20, if not done already, to determine if the taper applied in any of those years in order to identify the unused allowance available to be carried forward. Advisors will continue to play a pivotal role to help collect the appropriate information, perform the calculations to ensure clients do not fall foul of the allowances and face a tax charge on contributions over and above the maximum tax relievable amount. In cases where pension contributions are to be maximised, it will be important to identify how best contributions should be structured from a tax perspective. Take this case, for example. Here the client, Susan, is a company director and wants to maximise her annual allowance in 2019-20 and to bring forward an unused allowance of £10,000 from a previous year. In collecting all the necessary information, it's found that her total taxable income for the tax year is in the region of £140,000. She's not aware of the tapered annual allowance or the fact that she could possibly be affected by it. If the proposed £50,000 contribution is paid in full by the company, it will increase her adjusted income and lower her tapered annual allowance to £20,000. And with only £10,000 available to carry forward, it would lead to an annual allowance charge on part of the company contribution. If the proposed contribution is to be paid solely by the company, then the maximum payable without bringing a tax charge would be £36,666, as that would set the taper at £26,666, together with the available £10,000 carried forward on top. Better still if the contribution is paid partly or even wholly by Susan, as it may mean that the tapered annual allowance can be avoided completely, as the third box demonstrates. Clearly, financial advice will continue to be needed for those with higher levels of income to work within the tapered annual allowance provisions while they persist. For a few years now, there's been media speculation that the Government is considering changing the tax rules with the aim of cutting the cost of pension tax relief. HMRC forecasts the total cost of pension tax relief in 2019-20 will reach £39.9 billion. The House of Commons Library has produced regular reports on the subject. In its report, Restricting Pension Tax Relief, it summarised the way the Government has previously tried to cut the overall cost by reducing the annual allowance from its peak of £255,000 down to £50,000 in 2011 and then down to £40,000 in 2014, together with the introduction of the taper and the money purchase annual allowances that we have today. In its second report, Reform of Pension Tax Relief, the House of Commons Library detailed cross-party political agreement to changes being needed to reduce the overall cost of pension tax relief and to greater focus this valuable tax benefit on those that need it most. A range of possible options has been put forward to achieve this, from the removal of higher rate tax relief completely, the introduction of a pensions ISA with contributions made from taxed income, and further tinkering with cuts to the annual and lifetime allowances. Thankfully, no such changes have materialised so far, likely due in part to Brexit that's focused much of the government's attention elsewhere. It's clear, however, that pension tax relief is still very much under government scrutiny. Whilst the future of pension tax relief is unclear, one thing that is certain is that pension contributions paid now will attract the levels of tax relief that are currently available. Yes, it's possible that the rules could change in future, but if the tax relief has been already received and banked, then it can't be taken away. Okay, speaking of the lifetime allowance, the lifetime allowance, as you know, is currently set at $1,055,000. Based on the 1.7% increase in CPI in the year to September 2019, it's expected the baseline lifetime allowance will grow to $1,073,000 on the 6th of April 2020, or possibly $1,075,000 if the government again chooses to round up to the nearest multiple of 5,000, as it did for tax year 2019-20. The increase will be confirmed in the forthcoming budget and a statutory instrument issued to bring it into force from the 6th of April 2020. While the continued yearly increases may appear to be token amounts, any rise to the base level lifetime allowance should be welcomed after a series of reductions from April 2012 and complex transitional rules introduced each time to protect existing benefits. Even a small increase provides a number of advice issues that should be discussed with clients who may be affected. For example, working out who could be affected in future. Much will depend on the current level of the client's pension savings, the time period before benefits are likely to be taken, and the rate of investment growth achieved. Figures here illustrate who may possibly be at risk of breaching the lifetime allowance in the future. They assume that no further contributions are paid and are based on the fact that the allowance will continue to grow from its current level and assumed CPI increase at 2% per year. Those who look likely to breach the lifetime allowance and are planning to take benefits shortly may wish to hold off taking benefits until 6th of April 2020. In simple monetary terms, if the lifetime allowance grows to $1,075,000, then a short delay could save them up to £11,000 in tax. Those who have still not registered for Fixed or Individual Protections 2016 can still do so online, and it can be done at any time in the future, provided that they are eligible to do so. Those who have already registered for Individual Protection 2016 will effectively lose that protection come April 2020 if the amount that they have protected is below the new base level, and they'll simply rely on that new base level on that lifetime allowance thereafter. I put this slide together to be able to compare and contrast on a single page the various lifetime allowance protections that are currently in existence. In total, since the lifetime allowance was introduced, over 19,000 people have paid around £730 million in lifetime allowance charges. Obviously a huge amount of money, but contrast that with the ongoing cost of UK pension tax relief, which I said was around £40 billion per year, then the lifetime allowance isn't recouping anything like the initial government outlay. As mentioned earlier, the Office of Tax Simplification has recommended to government that the annual and lifetime allowances are reviewed against the policy objectives and to determine if both are required. It is an area we welcome simplification, as the complexity involved in operating 13 different benefit crystallisation events for multiple pension arrangements against 7 forms of lifetime allowance protection is complete overkill given the restricted levels of tax relievable contributions that can be paid. Whilst the provisions continue to apply, it is essential to maintain a good understanding of these protections, as the risks of not applying for protection where it is available or in losing protection inadvertently can be very serious. It's easy to dismiss the lifetime allowance as something that only affects those with significant levels of pension savings. However, many clients still hold entitlements to protected tax-free cash over 25% that they had on the 5th of April 2006. typically under occupational schemes, Section 32 buyout policies, and personal pensions where there's been a previous buddy or block transfer. It may come as a surprise to those holding tax-free cash protection with lower levels of pension savings that they may also be affected by the lifetime allowance increase. This is due to the fact that movements in the lifetime allowance are used to determine the overall lump sum available when benefits are taken, being the total of the indexed scheme-specific tax-free cash plus 25% of the additional funds that are deemed to have grown since 5th of April 2006. HMRC summarises all this in the complex formula shown. I won't explain in detail what each abbreviation means, but basically there are two steps involved in calculating the overall tax-free cash. The first part of the formula allows for the tax-free cash amount as at the 5th of April 2006 to be indexed by the increase in the lifetime allowance from its introduction at 1.5 million to its highest underpinned level, 1.8 million, which works out to be a 20% uplift. The second part of the formula allows for a lump sum of 25% to be taken from the additional funds that are deemed to have built up after the 5th of April 2006. These additional funds are worked out by multiplying the funds held on the 5th of April 2006 by the lifetime allowance in force when benefits are taken, and dividing the result by the lifetime allowance when it was first introduced at 1.5 million. The resultant amount is then subtracted from the final fund to arrive at a deemed value of funds that are built up after the 5th of April 2006, and with 25% available as a lump sum. Back when the lifetime allowance was falling from 1.8 million to 1.5, 1.25, etc., then the effect of the formula meant that the overall tax-free cash was increasing with every reduction. And now the converse is true, with the overall tax-free cash reducing as the lifetime allowance is now increasing year on year. The reduction in the overall tax-free cash available from 6th of April 2020 will again be small, but the effect continues to be cumulative, with further increases in the lifetime allowance in future years, causing further reductions in the overall lump sum available. Inevitably, some people will be over the lifetime allowance, regardless of small increases in the base level over the next few years. And for them, financial advice will be needed to minimise the tax charges arising. They will have a number of options available to them. Do they crystallise all of their benefits now, or only part of the benefits? Do they take any excess benefits as lump sum, or as income? Do they delay all benefits, or is there an opportunity to estate plan? So let's have a look at a couple of these strategies. Once the lifetime allowance is exhausted and further benefits are taken before age 75, the individual will generally have the choice of taking the excess as a lump sum, less 55% tax, or as taxable income, less 25% tax. Once they've reached age 75, the excess can only be taken as taxable income with the initial 25% deduction. So the lump sum option is no longer available once age 75 is reached. So what's best, lump sum or income? Well, it depends on the level of income tax prospectively payable when benefits are taken. The effective tax rates are shown here assume that the whole of the excess amounts are taxed at basic, higher and additional rates. In reality, very few people will be subject to higher or additional rate tax on all of their income. Tax is deducted at marginal rates after all. Indeed, I did some calculations recently to see what the marginal rate of tax would be payable on £100,000 of retirement income for someone over state pension age. And you may naturally assume it'd be mainly at 40%, but in fact the marginal rate of tax applying was less than 28%. And at low levels of income, the marginal rates are even less. So it's possible that taking any excess funds over the lifetime allowance as taxable income may be more tax efficient than taking it as a lump sum. Let's look at another example where taking specialist advice is needed in relation to the lifetime allowance, and where taking excess benefits as income can be advantageous. Here the client was a deferred member of a DB scheme with a paid-up entitlement to pension of £41,000 per annum. Taking this benefit from the existing DB scheme would not have led to a lifetime allowance charge due to the multiple 20 times pension plus any tax-free cash, falling well below the standard lifetime allowance. Further, the client was eligible to apply for Fixed Protection 2016 and a greater lifetime allowance of 1.25 million. In the time we've got available today, we're not considering the suitability or otherwise of the transfer advice. Suffice to say that the transfer only proceeded after a full and comprehensive review of the client's circumstances, income needs and objectives. The transfer recommendation also took into account the impact of all relevant tax aspects, including the effects of the transfer on his lifetime allowance. This recognised that a transfer from the DB to DC scheme inevitably will mean that a lifetime allowance charge will apply at some point in the future, as things stand, whereas no such charge would have arisen if the benefits had been taken from the transferring scheme. Was that the end of the world? Well, not in this particular case, according to the personal recommendation. The client registered for fixed protection 2016 and vested benefits immediately, but only up to the amount that exhausted their available lifetime allowance, deferring the other benefits and therefore delaying any lifetime allowance charge to a later date. So working through the example, the client had total DC funds after the transfer of 1.45 million with fixed protection 2016 and decided to vest up to 100% of their lifetime allowance of 1.25 million and simply leave the balance of funds uncrystallised. As things stand, the test on these funds could be delayed as late as age 75. At age 75, there will be a second benefit crystallisation check on the drawdown funds that will essentially test any growth on the funds since they entered drawdown. If there is any excess at that point, it will be taxed at 25%, with the balance remaining in drawdown to provide taxable income. The uncrystallised funds will also be tested at age 75, and as things stand, a 25% charge would apply to the full value as no lifetime allowance is available. For ease of reference, I've assumed no growth on the uncrystallised funds, and so a tax charge of 50,000 would apply, and 150,000 balance would be added to the overall drawdown pot to provide taxable income. So whilst the lifetime allowance charge can be delayed using this strategy, it's important to consider what would happen in the event of the client's earlier death. If the client was to die before reaching age 75, the uncrystallised funds will still be tested against the available lifetime allowance. Assuming the value of the uncrystallised funds remains at 200,000 for ease of reference, then the beneficiaries will be liable for a lifetime allowance charge at 55% if the excess funds are taken as lump sum, or 25% if the funds are used to provide income. The decisions taken by the beneficiaries will make a huge difference to the overall tax payable. Payment of a lifetime allowance charge on death differs from the position during the client's lifetime. On death, the responsibility for paying any lifetime allowance charge lies with the client's legal personal representatives instead of with the scheme. The scheme will provide benefits in full to the beneficiaries it chooses and will supply information to the legal personal representatives to be able to calculate any lifetime allowance charge due and to liaise with HMRC. Regulations set out the information that the LPRs will need to give HMRC if the client has insufficient lifetime allowance available to cover the death benefits provided. Here, if we assume that the client had nominated two beneficiaries to receive the death benefits from the 200,000 uncrystallised funds, one half each, and the scheme chooses to exercise its discretion and follow the nomination, then the tax charges would apply according to how they choose to take the benefits. If the beneficiaries both choose to take the excess benefits as a lump sum, then they'd be liable for 55% tax charge each on the lump sums and would retain 45,000 each after paying the appropriate tax charge. If the beneficiaries choose instead to take the excess benefits as income, then they'd be liable for only a 25% charge and would retain £75,000 in drawdown to provide income after tax has been paid. The clear advantage with the beneficiaries choosing to take excess benefits as income rather than as lump sum is that there will be no further tax to pay on the subsequent income on the basis that the client died before age 75. Even if that income is taken immediately and all in one go, or alternatively by way of yearly instalments. So the beneficiaries could reduce the overall charge on any excess funds from 55% to only 25% simply by taking the income option, provided that they know about it. This is another example where taking benefits over the lifetime allowance in the form of income can be more tax efficient. This tax planning opportunity will only be possible if the DC scheme that the client is in offers chosen beneficiaries an income option on death as well as a lump sum, and likely only if the beneficiary has been brought into the advice process, as without advice many will simply choose the lump sum option and pay too much tax in doing so. Many investors automatically assume that full death benefit flexibility is available from all of their existing pension arrangements and to all possible beneficiaries, and that might not be the case for some schemes. If you can forgive the quick product push, I can confirm that full death benefit flexibility, including the ability to nominate any dependents and nominees and ultimately successors for income and lump sum options, including individuals including providing income to minor children, is available on ARCSIP, on Aegon One Retirement and on the Aegon platform. This opportunity also assumes that the client has supplied a nomination naming these individuals as potential beneficiaries in order to secure this tax advantages on the funds over the lifetime allowance. Many clients don't understand why it's appropriate to keep nominations up to date and simply complete a nomination at the outset of the policy and fail to review it again. It's far more likely that a scheme will exercise its discretionary powers and pay benefits to the right beneficiaries in line with the client's wishes if the nomination is kept completely up to date. Too often, we come across cases where no nomination has been made or it was made many years ago and may not reflect all the parties that the client would want to benefit. In these circumstances, we will carry out a normal process of collecting all the information we need to exercise our discretion and choose the beneficiaries, but the difference here is that if the parties have not been named by the client, we may be restricted in terms of the form of benefits we can offer the beneficiaries chosen. In conclusion, on the pension side, I believe that these are the key areas as we approach the end of 2019-20 and the start of the new tax year. Normal tax planning, using pension contributions to minimise income tax payable and to protect existing benefits and allowances, maximising the annual allowance and any carry forward for higher rate taxpayers and those subject to the taper annual allowance to secure the highest level of tax relief available. Determining what impact, if any, the increase in the lifetime allowance will have for any client who are affected or who may be affected in the future, securing protection where it's available and mitigating any lifetime allowance charge where it arises. For this group, it will likely that they'll want to look at alternative forms of savings and investment if pension contributions are no longer possible. And don't forget the impact of the increase on those who have protected tax-free cash at the 5th of April 2006. And finally, for investors with uncrystallised and drawdown funds, not just those over the lifetime allowance, but everyone else too, they should be asking themselves, what are my available death benefit options? How do I best make adequate provision for my beneficiaries? Will my existing scheme offer this new benefit flexibility, or will I need to transfer to a scheme that does? And finally, death benefit nominations need to be put in place and regularly reviewed, reconfirmed or updated as circumstances change. Okay, with that, I'm now going to pass over to Elaine, who will cover off a whole range of additional tax planning opportunities. Many thanks for your attention so far, and as I said at the start, please do get in touch with us via your usual Aegon contact if there's anything we can do to help you. Elaine, over to you.
Thank you, Martin. In this part of the session, I'm intending to take a look at some of the other income tax, capital gains tax and inheritance tax planning opportunities available. So let's start now by looking at some income tax planning opportunities. The marriage allowance allows a spouse or registered civil partner to transfer £1,250 of the personal allowance to the spouse or registered civil partner. The lower earner must have income totalling less than £12,500, the prevailing personal allowance, and their spouse or registered civil partner must be a basic rate taxpayer. The marriage allowance has to be applied for online with HMRC, and it's worth remembering that the allowance then transfers automatically in subsequent years until such times as it's cancelled. The self-employed can claim the allowance via their self-assessment tax return, and the employed can have their tax code adjusted. The transfer of a part of the personal allowance could result in a maximum tax saving of £250 in 2019-20. If either spouse were born before the 6th of April 1935, they can apply for the married couple's allowance instead. The personal savings allowance applies to bank and building society interest distributions from collectives, interest on the cash account on a platform, and other types of savings income, such as the taxable income from a purchase life annuity or chargeable event gains on investment bonds. Basic rate taxpayers can benefit from an allowance of £1,000, higher rate taxpayers an allowance of £500, and additional rate taxpayers don't qualify for any personal savings allowance. The income which is covered by the personal savings allowance still counts as taxable income and could push a taxpayer into the higher rate threshold for other taxable income or could impact on their applicable CGT rate. Individuals benefit from a £2,000 tax-free dividend allowance, and dividends in excess of this allowance will be taxed at 7.5%, 32.5% or 38.1% depending on the tax status of the investor. It's worth considering that the £2,000 dividend income, whilst covered by the allowance and tax-free, still counts as taxable income and could push the investor into a higher tax bracket for any excess dividend income or for CGT purposes. Clients should consider transferring assets from a spouse who pays tax at a higher rate to a spouse who's a non-taxpayer or basic rate taxpayer. This will help to make sure that both spouses are using their personal allowances, basic rate bands, the tax-free dividend allowances and their personal savings allowances. Parents could also consider gifting assets to their adult children to allow them to use their available allowances and basic rate band. If the children are under 18 and parents gift their children assets, for example, using a bear trust, the income will still be assessed on the parent if this is greater than £100 per parent per child. If the children are gifted assets from anyone else, then the income will be taxed at the child's marginal rate of income tax. The ISA allowance is £20,000 for this tax year and next, subject to confirmation obviously in the forthcoming budget. And £4,000 of this allowance can be saved into a lifetime ISA. An individual can invest in one cash ISA, one stocks and shares ISA, or a combination of the two in the tax year. As you'll all be aware, the ISA allowance can't be carried forward to the next tax year, so it's a case of use it or lose it. ISAs are tax-efficient investments as dividends, interest distributions and capital gains within the ISA aren't subject to tax. Given that clients can benefit from the personal savings allowance, the dividend allowance and the CGT annual exemption, you might wonder if a cash ISA or a stocks and shares ISA are still worthwhile. The tax-free dividend allowance reduced to £2,000 from 2018-19 from 2018-19, and future governments could abolish the dividend allowance and the personal savings allowance altogether, as these are relatively new allowances. Also, income yields from a client's investments could grow over the years. As a result, it could be better to hold the investments in an ISA wrapper where the ongoing tax treatment could be more beneficial, as the personal savings allowance and dividend allowance are more limited in size and scope in comparison. Additionally, any growth on the underlying investments won't be subject to CGT. Parents can also consider investing £4,368 into a junior ISA for their minor children this tax year. In addition to the personal savings allowance, a client might be able to benefit from some or all of the 0% savings rate if their earned income or pension income is less than £17,500 in the tax year 2019-20. £17,500 being the total of the personal allowance of £12,500 and the £5,000 0% savings rate. There's a little example on this slide to illustrate how this could work in practice. If you have an offshore bond with a chargeable event gain of £18,500, the non-tax-paying policyholder could cash in the bond and make use of their personal allowance, the 0% savings rate, and the £1,000 personal savings allowance, resulting in no tax being payable. Alternatively, if the actual policyholder is a higher or additional rate taxpayer, they could consider assigning the bond to the non-tax-paying spouse or adult child for them to subsequently cash in to benefit from the 0% savings rate. But it's worth bearing in mind that any new investment following the assignment should be made in the spouse's name or the adult child's name, depending on who the assignee actually is. Let's now compare the income tax relief for enterprise investment schemes, venture capital trusts, and seed enterprise investment schemes. With an EIS, the investor receives 30% income tax relief on the cost of the investment in the shares, up to a maximum investment of £1 million or £2 million, where the excess over £1 million is invested in knowledge-intensive companies. The relief will be clawed back if the shares are disposed of within 3 years. With an investment into a VCT, the investor benefits from 30% income tax relief on the cost of the shares, up to a maximum investment of £200,000. The investment has to be held for 5 years to benefit from the income tax relief. And then finally, with an SEIS, the investor can benefit from 50% income tax relief on the cost of the shares, up to a maximum investment of £100,000, and the shares have to be owned for 3 years to qualify. Moving on now to capital gains tax planning. Everyone is entitled to a CGT exemption, which is currently £12,000. This again is a use it or lose it exemption, as it can't be carried forward to future years if it's not used. Clients might want to crystallise gains in the year to bank these gains and reinvest the proceeds. They might want to rebalance their portfolio, or alternatively, they might want to realise cash to fund ISA or pension contributions. If clients want to sell down a holding which has a large unrealised gain, they might be better to sell some of the shares in this current tax year and then some at the beginning of the next tax year to make use of 2 years' worth of annual exemptions, obviously bearing in mind that that's on the assumption that CGT rates don't change in any forthcoming budget. Investors will have to be careful to avoid the same-day or 30-day matching rules if they want to make use of their annual exemption and buy back shares of the same holding and class. We'll look at these rules in a minute. They could sell the shares or units and buy these shares or units back within their SIP or ISA, and this wouldn't trigger the same-day or 30-day matching rules. Instead, the actual gain would be crystallised. Alternatively, they could sell shares or units and their spouse could buy these back. As a last resort, they could buy the same shares or units back after 31 days, but they would have to suffer the out-of-market exposure in the meantime. This is on the assumption that actually they want to keep the same shares. If one spouse pays CGT at a lower rate than the other, then it might be worth transferring assets from the higher to the lower rate tax-paying spouse to benefit from the annual CGT exemption and lower capital gains tax rates. If a higher rate or additional rate taxpayer has crystallised gains in excess of the annual CGT exemption, they might want to consider making a pension contribution to a registered pension scheme operating tax relief at source. This could result in the capital gains on assets other than residential property being taxed at 10% rather than 20%, as the pension contribution will lead to the client's basic rate band being extended. As I've already mentioned, there are matching rules which apply when shares are disposed of. The cost which appears in the CGT calculation will be the cost of any shares of the same class bought on the same day, then the cost of any shares of the same class bought in the 30 days after the date of disposal, and if neither of these applies, the average cost of the disposed shares will be used. The matching rules can be complicated, and the CGT calculator available on the platform you use should take these into account when performing the calculation. Done a simple example on this slide to highlight the difference that the matching rules can make to the calculation. As you'll see in the top line of the table, if the shares are bought back on the same day, it's the cost that he buys them back for which appears in the calculation, namely $12,500 rather than the original cost of $5,600. This means that he incurs a loss for CGT purposes. However, if he were to sell the shares and buy them back immediately in his SIP or ISA, it would be the original book cost of £5,600, which appears in the calculation, meaning that he'll be able to utilise more of his annual CGT exemption. CGT calculation involves a number of steps. As you can see, the gains in the year are netted off against losses realised in the year before the annual exemptions deducted. It might be worth holding off realising some losses until the new tax year, rather than wasting them in the current tax year, if the realised gains will be covered by the annual exemption. A strategy like this will obviously have to be weighed up against the investment risk of holding the assets for longer and the loss becoming larger. Losses from previous years can be offset against the net gains too, to reduce the taxable gain in the year. I've used a little example here to put some numbers around the CGT calculation. As you'll see, the losses realised in the year of $12,500 are offset against the gains in the year of $20,300 before the annual allowance is used. This means that £4,200 of annual allowance is effectively wasted, and from a tax perspective, it might have been better to delay crystallising £4,200 of losses until the subsequent tax year. The Office for Tax Simplification published a report on the 5th of July 2019, raising some suggested changes that could be made to inheritance tax. To date, we haven't seen any legislation covering these changes, but we might see some of these come through in the next budget. However, let's look at some of the current inheritance tax planning opportunities your clients could consider at the moment. Given that the no-rate band is frozen at $325,000 until 2020-21, some other possible strategies that a client could consider are making sure that their will is up to date and reflects their wishes. Spending their wealth during their lifetime can help to ensure there's nothing left to tax. This might be considered a bit of a drastic strategy though. Making lifetime gifts to other individuals or to a bare trust, which would be potentially exempt transfers, or gifts to most other types of trusts, which would be chargeable lifetime transfers. Creating a legacy for their family with life insurance, for example, putting a whole-of-life policy in trust to meet the IHT liability which arises on their death. Gifting some of their assets to charity. This will either be an exempt transfer this will either be an exempt transfer and be deducted from the receipt before IHT is calculated, or the rate of IHT applying to the receipt on death will be reduced to 36% if more than 10% of the net estate is left to charity. Other IHT mitigation strategies could include creating a trust, such as a DGT, or discounted gift trust I should say, or a loan trust, investing in shares which attract business property relief, setting up a family investment company, or a family limited partnership. There are a number of IHT exemptions that a client can consider using before the end of the tax year, such as the small gifts exemption of £250, the annual £3,000 exemption, gifts in consideration of marriage, gifts to spouses and registered civil partners. This will be a maximum, though, of $325,000 of an exemption if the spouse is non-UK domiciled. And gifts which qualify for normal expenditure out of income exemption, and gifts to UK charities. It's also worth considering whether some of the client's assets will attract business property relief or agricultural property relief. If you have any queries or want further information, then please don't hesitate to contact either of us or your usual Aegon sales representative. Our contact details are on the screen for you now in case you want to contact us following this webinar. Thanks for taking the time out of your busy schedules to listen to our webinar, and we really appreciate it and hope you found it useful. Thank you.